In this presentation, we will add new accounts to our chart of accounts and add the beginning balances related to them within QuickBooks Pro 2020, QuickBooks Desktop 2020. In other words, our objective will be to add new accounts, but also add the beginning balance as of the time period that we are starting the new company file. We're starting a new company file here. We have the chart of accounts that we have generated from QuickBooks. However, there are some accounts that we need to add, some accounts that have beginning balances from the prior system that we need to put into our system as of the starting point that we will start to account within it. Here we are in our Get Great Guitars file. We currently have the open windows open. You can open the open windows by selecting the View dropdown and selecting the Open Windows list. We're now going to take a look at the financial statements to see what we have so far. So we're going to go to the Reports dropdown. We're going to go to the Company and Financial. We want to then take a look down here at the Balance Sheet Standard report. Now remember, we're starting our report as of the beginning of 2020. That in essence is the cutoff date. So we're going to say, all right, as of, let's say 01/01/20, the first day of the current time period, we need to be inputting our beginning balances. As we did so, it's a little bit more problematic than we might think at first, because not only do we need the beginning balances on the trial balance, but we needed to break out the backup or supporting information for some of them. Therefore, we've already entered the beginning balance for the receivables. It can be difficult for the receivables because we have to be also entering the supporting information, including the customers and who is owed. We've set that up in prior presentations. We set up the inventory, which again can be a little bit more tedious to set up. We can't just do it with one-time journal entry because it's not just this account. It has the supporting documentation, the supporting ledger, telling us what inventory is included here and the cost of that inventory. We also set up the accounts payable. Once again, that is who we owe to, but once again having that problem of not only needing the amount on the trial balance, but also needing the supporting documentation, the vendors that we are paying to. Now we're going to go to some of the other accounts which are a bit more straightforward. For example, we're now going to go to cash. We don't have our checking account here. This is usually the one, even if we're starting a company from scratch, oftentimes we have a checking account that we may have started or put together before we get the QuickBooks file going. And therefore, we need to put, many people, even if they're starting the business from scratch, need to put a beginning balance into cash. We're going to be taking the same approach here. We're going to set up the account. We're going to be putting in the beginning balances into those accounts using QuickBooks. QuickBooks will then do whatever it has to do to force a journal entry, to force a debit and credit, to force two accounts to be equal, to force the accounting equation, assets equal liabilities and equity, to be the same. And so we're not going to have to worry about that. We're just going to put the beginning balance in there as long as we do it before the starting point, as we've done in the past, before January 1st. Any kind of effects that are going to be on the temporary accounts, income statement accounts, should roll over to equity, which is in essence where we want it as we start going forward as of January 1st, 2020. Now note, as we do this, it might be more proper actually to do this with journal entries to enter this, but we're going to use the QuickBooks system. The reason I say it might be more proper or easier to think about is because then we could set up the accounts, do the journal entries, and tell QuickBooks exactly where we want the other account to go, which is typically going to be something like increase in the balance sheet account, like cash, the other side going to equity. But if we use QuickBooks system, it'll all kind of wash out to equity anyway, so both methods will work fine. If you enter journal entries, you're taking more control of it. You know exactly what's happening on both sides of the transaction. As we enter these beginning balances, we got to think, okay, what is QuickBooks going to do? QuickBooks is going to have to do something because I only told it one side of the transaction. It's going to have, as we've seen in the past, it'll do something. And then we'll go check it out and see if it did what we think it should do, and then make corrections if necessary. Most of the time, these accounts will do what we think it should do, which is to put the other side in some way, shape, or form to equity. Then we could just adjust the categories of equity, such as the opening balance to equity. Okay, so we're going to start with the cash account. To do these, I'm going to go back to the Home tab. I'm going to go then to the Chart of Accounts. You can get to the Chart of Accounts from the Home tab here in the Company area, Chart of Accounts. I prefer to do so with the drop-down menu. I go to the Company, and I'm going to go to the Lists, and then we're going to go to the chart of accounts. This is our major list. I like doing it this way because this list format in the dropdown is there no matter what window I currently have open. You'll recall that our chart of accounts will be in order by type. The type is the most confusing thing for most people. Most people could say, okay, I'm going to put a cash account in here, I'm going to put another account in here, but what type of account should it be? Why does it matter? So just remember that the types are basically broken out in order: assets, liabilities, equity, income, and then expense, and then into more details such as specific types of asset accounts, right? And specific types of liabilities and equity and so on. The asset accounts need specific types for things like accounts receivable so that it can track things like the supporting customers. And so the cash account has specific details that it needs as well. And then other current assets is basically the current versus long-term, and so on and so forth. We're going to be creating a cash account, which of course will be a cash type account and will then be on the top, it being an asset and it being the biggest asset, or our favorite asset, cash. So we're going to go to the account drop down up here, which is actually a rise up. So it's got the drop down arrow, but it's really a rise up thing. And we're going to go to the new. Now this is going to be a specific type of account. It's going to be a bank account. So we're going to say this is a bank account. You got to put it as a bank account, not just an asset. It's a bank account, specific type of asset account. And then we're going to go continue. And you need to do that, by the way, because the ledgers that QuickBooks will set up for the bank account will be slightly different to track what is necessary for a bank type of account. Okay, and we're just going to call it a generic name, which is the checking account. Now, if this is your actual bank account, you have a few different options that you want to think about with making the names of these accounts. Note that the QuickBooks system will be making the balance sheet with the actual names that you have in these accounts. So if you put something like, Bank of B of A, or abbreviate Bank of America or something like that, and you put the account number in it or something like that, that will show up on the balance sheet reports too. So there's could be kind of a drawback, because if you give that report to someone else, it could be kind of a drawback. However, at the same time, you kind of like that detail on the trial balance. So you kind of got to go back and forth and think, how much detail do I want on my information? I think more detail is better than less if it's your personal accounting file. In other words, I think it would be good if you would have the bank account and call it, Bank of America, and possibly just the last 4 digits of the bank account. If you have multiple bank account numbers, that makes it a lot easier to think about, which bank account is yours. To use those last 4 digits, those are the ones that change. Now, if you're concerned about running reports, then you could possibly make a banking account that's going to be a parent account, and then make the actual banking accounts subsidiary accounts. So then you'll have a cash basically account, and then the subsidiary accounts to it. And then when you make a report, you can collapse the subsidiary accounts into the cash account, just showing the cash account without the detail. So I think for most people starting out, however, more detail is better than less detail. So again, I would, especially if you have multiple checking accounts, I would think to put the actual checking account and then the number. Loans, the same thing. I would put the actual loan, who I owe possibly within the loan, and then the loan number on it to make it as easy for me to know exactly what I'm dealing with. Here, it's going to be a bit generic. It's the only checking account we have. I'm just going to put checking account. And then we're going to be, if we scroll through this, we don't need a sub account. Now, sub accounts, some people love sub accounts and some people don't like them. Obviously, somewhere in the middle is good. You don't want to have too many accounts because it just becomes tedious to do the bookkeeping. But you want to have enough accounts to give you enough detail to basically make the decision-making process. So you're weighing between the time it takes for more detail and the added information that it gives you. Many people like the sub-accounts because it allows them to give more detail and then collapse it and show reports to other people without all the detail or with it. So it just depends on what level of detail type person you are. Do you want a bottom line kind of statement? This is the major groups, or do you want to have more detail so you can dig into it, get more detail? Note, as you do more detail, however, of course, it will take more time to enter the data for it. Description, we don't need a description here, and the bank account number we could put here, and the routing number, again, not always necessary unless you're going to be, connecting and making transactions directly from here. So I'm not going to enter that information. Tax line, note that the tax line could be useful if you are basically exporting this information to the QuickBooks tax software like a TurboTax. QuickBooks owns TurboTax, or Intuit owns QuickBooks and TurboTax. Most people, though, don't do that. It could be a little bit confusing to do that, and it's not the easiest type of integration to have. And usually, if you look at these lines, it confuses people. So I would say for most people, you don't need to do this. What you really need to do is create an income statement so that when you or somebody else creates the tax return at the end of the year, they can have that income statement that's the document that they would use to then input to the tax return. If you do all this work, it could save some data input time into the tax return, but really, it's not that difficult to enter an income statement into the tax return. So I'm not sure how much more value this is going to provide usually. It may get better in the future, and if it does, my opinion changes, I'll let you know. But I do taxes, I do QuickBooks. I don't see many people using that, and when they have, it hasn't worked out as succinctly as you would like. So I would recommend you don't necessarily need it. And then we're going to go to the enter opening balances. So I'm going to select the enter opening balances. Remember, this is the only time you want to use this field is when you're first starting out the file. Other times you don't want to enter any opening balances, even when you add new accounts. But when it's the first time that you're going to set up those beginning balances, you may want to do this. Now, of course, the beginning balances is going to be what was there at the end of the last time period. And this is also going to be something that's going to be necessary when you start doing the bank reconciliations, because the beginning balance will be in the bank reconciliation. So we're going to say this is going to be the statement ending balance is going to be $25,000. And then we're going to say the statement ending date, and we're going to say is 12/31/19, the last day of last year, and then the current day of this year, then we should be good. Now, again, this is going to be increasing the bank balance. QuickBooks is going to have to put the other side somewhere, $25,000 somewhere else, probably to opening balance equity, I would guess, but I don't really know. Kind of QuickBooks is going to just do whatever it can to make things reconcile. Where should it go? It should go to equity somewhere. Okay, so we're going to say okay, and then we're going to go save and close. So there we have the first transaction. Here's the bank account. Notice, of course, it's on top because it's an asset and it's our most favorite asset. The next one we're going to enter is a credit card liability type of account. So the credit card liability type of account is going to be kind of a liability down here, and a specific type of liability once again. Before we do that, however, let's go to the balance sheet just to see that cash account pop up. If we go to the balance sheet, we'll say, all right, boom, there's the cash. Cash has come up here. The other side, you'll note, went into the opening balance equity. So in other words, if I was to double click on the cash account and say, okay, now let's take it to the prior year, 19, so I could see the data, which happened on 12/31/19. There's the 25,000. The other side, the split, they put it to opening balance equity, that funny account that they put in there. We're going to have to clear it out of there, but at least it's an equity account. That makes sense. So we're going to say, double click on that. They created a deposit slip. Why? Because that's the slip that's the field, that's the form QuickBooks uses when cash goes up. So therefore, they created a deposit slip when we entered the opening balance. So I'm going to close this back out and close this back out. The other side then, of course, is in equity, opening balance equity, funny account. We're going to clear it out of here, but at least it's in an equity account. QuickBooks is saying, hey, I know this is a funny account, but we're just telling you this is where we put all those funny things that we didn't know what to do with because you only told us half of the transaction. So here's the 25,000 in the opening balance equity. All right, next one, Visa card. Closing this back out, we're going to go back to our chart of accounts. We're going to then go to the accounts drop down, which is a rise up, and we're going to go to the new, and this time we want a credit card type of account. So it's a liability because we're going to owe the credit card company, but it's a specific liability so that it can track the credit card and the opening balance in it, more specialized format than other current liabilities. So we're going to say, all right, it's a credit card type of account. We're just going to call it a Visa. And once again, if you have multiple credit cards, notice what this is going to do. It's going to show up in our statement as Visa. right? And if I had an account number, I might want to put the account number at the end of the account name to track each account, because I would rather track each credit card separately in its own statement. So, but this is going to show up on our balance sheet then, it's called Visa, which, it should be on there if I was going to make it properly. It should be under just a current liability for a credit card payment or something like that, not really, who we pay, Visa being the vendor. So if you wanted to make it more formalized, you could, or if you have multiple credit cards, you could make one called credit card liability, credit card payable, and then make subcategories of multiple credit cards, Visa, American Express, and so on, so that you can then see the detail of the multiple credit cards and collapse them into one simply credit card item for giving a report that just shows that condensed situation. Now, again, I think for most people to have the Visa there, to have more detail is more important, because they're using this as their personal, to get in there and to work around with it. So therefore, I would put the Visa and possibly the last 4 digits of the Visa card, especially if you have multiple cards, so that you can easily go in there, track the account that you're working with when you're doing that data input process. So no sub account, no description. You could put the card number here, not necessary. I'm not going to put a tax line. We are going to need, however, an opening balance. So I'm going to select the opening balance. And for the credit card, we're going to say it's going to be $1,000. We owe $1,000 for the credit card as of, once again, 12/31/19, the end of the last time period. We're going to then say OK. So there's the opening balance. And again, QuickBooks is going to have to do something with the other side of it. Let's see what it does. We're going to say save and close. And we're going to close this out. And then if we go back to the balance sheet and say, all right, what did it do? Well, there's the Visa. So notice it did put in a subcategory of credit cards within Visa. So notice we don't need to necessarily make the category, because notice you can collapse this now, the Visa credit card. So if I wanted to print this statement here with it being collapsed, or if I want the detail, we have the detail within there. And notice the cash is the same way. So you don't really need a subcategory, as I was saying, because they basically make one for you here. So I could collapse the checking and saving type of accounts, and that gives you the checking and saving account. And if I was to open them up, that's going to give us the detail. So that allows us then to get the more detail within the checking account. Just remember, if there's an item that doesn't collapse in that format, the way you can create something that will collapse, this is in essence a subcategory. So a subcategory, if you will be treated in this way. If you make a parent category, subcategory, then you can in essence collapse generally the parent category and the subcategories within it. So here's the Visa card. There's the 1,000. If we double click on it then, and then go to the prior time period last year, we've got the 12/31/19. There it is. The other side's going to opening balance equity. If I double click on this item then, we have the credit card purchase charge as the driving documentation to create this field. Closing these two back out. If we then go to the equity down here, opening balance equity, double clicking on that, go into the prior time period 01/01/19, we then see our transactions. There's the 1,000 in the credit card. Closing this back out, this brings us back to our balance sheet. Back to the chart of accounts, we're going to now enter a long-term liability type of account. Long-term liability, we owe basically a loan. It's going to be a liability. I'm going to go to the drop up or the rise up new account, and it's going to be a long-term liability type of account. So we could choose loan here, but I like to put it into the long-term liability. So I'm going to say long-term liability, and we're going to continue. And this is going to just be called, I'm going to call it loan payable. And same kind of grouping could happen. Now, if you put it into the loan category, it may help to group for you. But just note that the loans are another area that could be a little bit confusing, because if you have multiple types of loans, you have to determine whether or not you just want to group them in one loan, or if you want to group them in multiple loans, and whether you want to be breaking out the short-term and long-term portion of them. To me, I would think that you, in the QuickBooks file, you typically want to put them, I would make a new loan account for each loan, possibly having the name of the loan and then the last four digits of a identification number of the loan, and then possibly if you want to collapse them, put them into a parent type of account as well, so that you can collapse them. I wouldn't make a short-term and long-term portion all the time, but possibly do an adjusting entry to break out the short-term and long-term portion. So I would think best practice normally, if you have multiple loans, to make one loan account for each loan rather than grouping them all into one account, and then break them out the short-term and long-term portion on an adjusting entry type format. So we're just going to have a general kind of a loan, generic type of loan here. Then we'll put in the opening balance. So then we'll go to the enter opening balance, and we're going to say it's for $22,000. The loan's for $22,000. Date as of 12/31/19, the last day of the prior period. Okay. Then we're going to say save and close. Check out the balance sheet. Save and close. Back to the balance sheet. Let's see what happens. We have the $22,000 in the liability. If we were to open that up then and look at 2019 01/01/19, then there's the journal entry. Notice it didn't have, there's no form that it could use to drive this, like a bill or a check or anything like that. And therefore it went to the journal entry. That's like the last resort that it can go to. The other side went to the opening balance account. And if we double click on the 22, it goes to a journal entry type format where this is a ledger. If I go to this, double click here, you'll see the actual journal entry. So again, if there's no driving form that's standardized to make a certain transaction, QuickBooks will then go to the journal entry. So I'm going to close this back out, close this back out, close this back out. And now we're back to the face of the page here. The other side, of course, in opening balance equity, if we double click that, change the date from 01/01/19, prior time period, we then see the 22,000 also here. Now the next one we want is furniture and equipment, so that we have some furniture and equipment we need to put on the books. If I close this back out and I say, okay, there's no furniture and equipment on the balance sheet note. However, note that because it's not on the balance sheet does not necessarily mean that it's not in the chart of accounts. Because the chart of accounts, it won't show up on the balance sheet unless it has something, there's some activity in it. And so we still want to go to the chart of accounts here and check and say, hey, do we have an account for furniture and equipment? And if so, then we'll use that one. If not, then we'll add, a new account. Now, if we go through here, we see that we have the furniture and equipment here, right? So we have that account already. That's long-term assets type of account, depreciable type of assets already set up. All we need to do then is add the opening balance to it. So what we will then do is I'm going to edit that account. I'm going to go to the drop down rise up, and we're going to go to the edit account rather than the new account. And then within here, all we need to do is enter the opening balance. Now, if you don't like the name, if it's furniture and equipment and all you have, or you're talking about equipment, or you want to break out furniture and equipment or something like that, you could change this. However, note that this is kind of like the default settings for QuickBooks, and it's telling you these are kind of like industry standards. They're not, don't take that as written in stone or anything, but if they're thinking that they're industry standards and we're not, experts within the industry, we want to rely on QuickBooks to some degree and then only make the variations when we think it's going to add to our value, either with more detail with us looking into it, or some other kind of method that's going to help us. So we're going to say enter the opening balance. The equipment and furniture we have, we're going to say is $75,000 as of 12/31/19, the last day of the prior period. We're going to start here again in 2020. So we're going to say okay, save and close that one, and then I'm going to go to the balance sheet once again. And we'll see, all right, furniture and equipment, $75,000. There it is. If I double click on it, if I go to the prior time period, which is 01/01/19, there we see it in 01/01/19. There's the $75,000. No transaction for it, or no form for it. There's no form that it could use. Therefore, it used the journal entry. So if we double click on it to zoom into it, we see in basically a register type format here. It's a journal entry here. If I double click on the journal entry, you can see the actual debits and credits. Okay, so if we close this back out, close this back out, close this back out, the other side, once again, go into opening balance equity down below. If I double click on opening balance equity, change the dates to 01/01/19, we then see that we have that amount in the opening balance equity here for the $75,000. closing this back out and going back to the balance sheet. Now the last thing we're going to do is make an adjustment to the inventory assets. So the inventory assets here, we're going to add a few more of the items. So to do that, we're going to go to the lists dropdown. We're going to go to the item list. Here's the item list. We're going to go to the item drop up or the rise up, and we're going to go to the add edit multiple items. And so add edit multiple items, we're back into our input screen. We want to then have the inventory items, selecting the inventory items. And we're going to say that we have a couple more items that are going to be on hand. One is going to be we're going to call it an SSB, which is going to be a Steinberger solid body. It's a type of guitar, of course. And we're going to say that we have on hand 410 of those. And the sales price, on hand, the cost is not going to be 410, but 328. The sales price is going to be the 410. The cost of goods sold is the account it will be going to. Merchandise sales is going to be the income account. The asset account is going to be inventory assets, the amount that we have on hand. We're going to have one on hand. The date is going to be 9/20/19. Now I'm going to say the date is as of 12/31/19. 12/31/19. And tax, we're going to say it is on the tax item. Now notice that these defaulted back to 9/20, and the reason for that is because I'm doing this before 2019. If it was usually when we're going to be entering data, it's going to be past the time that we're going to be entering the data for, so that won't happen. Now, because these are all in the prior year and we're going to start in 2020, it doesn't matter because it's in the prior period. As long as it's in the prior period, we're going to start entering data as of 2020, so it will be fine. So then we're going to say the next one, then we're going to save that and then take a look at what happens. So we're going to close this back out. I'm going to close this back out and then go back to our balance sheet. And within the balance sheet, within inventory, we've got the 2008-96. Double clicking on that then and go into the prior time period 01/01/19. We see the detail here related to our inventory. So this is what we have so far on the balance sheet. So you want to go through here and just basically double check the numbers as we go. If anything is off, then you could double click on the detail and check out that detail and review it. Go back to the prior presentations where we had basically input each of these transactions individually. Also at the end of this, we will be doing a transaction detail report, which is a great review documentation as well. So we've got the checking account, we've got the accounts receivable, we've got the inventory, we have the furniture and fixture, we have the accounts payable, we've got the Visa, and notice the subcategories down here. Don't let the subcategories basically throw you off when you're checking the accounts. And, and then we got the loans, we've got the equity, which is the opening balance, and the owner's equity. Now, again, this opening balance, that's kind of a problem for us because it doesn't look professional to have that. If you give this to someone, you have this opening balance, they're going to suspect that you entered things that you didn't really understand and QuickBooks just made this account, which isn't really a real account. So we need to do something with that. We will adjust out of the opening balance and adjust it to the equity account.